from the heart of Dubai, where tomorrow is being built today, to the world. Welcome to the CTO Show with Mehmet. Here, we redefine technology and reimagine possibilities. With Mehmet, delve into the riveting realms of AI, cybersecurity, and digital technology. Experience the thrilling highs and lows of startups. Immerse yourself in the spirit of entrepreneurship and witness the future of business innovation being written in real time. Now, without further ado, let's tune in and explore the future.
Hello and welcome back to a new episode of the CTO Show with Mehmet. Today, I'm very pleased. Joining me, Daniel Nikic. And Daniel, the way I love to do it is I keep it to my guests to introduce themselves. So feel free to, tell us more about you, your background, your journey, what you are currently up to. We're gonna discuss like very important topics, I would believe, related, to global markets, opportunities, due diligence. So without further ado, I will keep it to you. The floor is yours.
Well, thanks for having me, Mehmet. It's a pleasure to be on this show. To give you a little bit of background about myself, I'm currently based in Croatia, but originally I'm born and raised in Canada, and hence my last name, it's quite unique. My parents are from Bosnia and Herzegovina, so I was always interested in the international markets and what's going on in the world. I guess the immigrant thing. And my background has always been in business, like in university. I finished in business administration at Brock University, which is in St. Catharines near Niagara Falls. For those who don't know, but they probably know of Niagara Falls. It's a big landmark tourist destination in Canada. And I moved to Croatia in 2009, first to see how Europe was. And also, you're young. I was 21 years old. I wanted to see the experience. And I would say throughout all my work experience dealing with market research and financial analysis, the best way to know something's right is doing it yourself. You have to go with your gut feeling. And this is why I'm bringing up this story. And I worked in management consulting, real estate development, and with my own company, Chorus, which I established in 2014, which stands for Coherent Research. Pretty simple. I worked with international entrepreneurs from Japan all the way to Canada. And I also worked with investors interested in global markets. And I would say this to begin with, the one thing I would say about myself and that I learned from successful people is being able to adapt to different situations and sticking
Great.
to your gut. That'll be one thing I would definitely state in the beginning.
Great. And thank you again, Daniel, for being here with me today. Now, I gotta start, from little bit of the work that you have done. So you've analyzed more than 15,000 companies across US, Europe, and Middle East. Um, what like kind of patterns did you start to see after the first few thousands, I would say?
One thing I noticed after analyzing a few thousand is usually companies that I've analyzed that go from seed stage. For those who don't really know what seed stage is, that's usually when a company's a bit pre-revenue or just a bit to see some revenue and going to post Series A. It's usually the founder and the team are passionate about the idea, but also they can deal with the stress and being able to control your emotions. It seems pretty interpersonal skill set, but it's very important in business. And a lot of companies go with the trends. So we saw before in the 2010s, it was the SaaS. Then post, I would say COVID, and after we see a lot of AI popping up. And one thing I would state that a lot of companies and founders that know how to deal with the finances and know their market seem to be quite successful. And they have to believe in their company is going to be successful. You have to have self-belief. It seems simple, but it's true.
Yeah, Daniel. Um, So, this is very important, what you just mentioned, especially about, the work with the entrepreneurs. So if I want to ask you also based on this experience, because you look at different geographies, right? So worldwide. So from your perspective, like your world view, what do you think made you decide on it the most? I mean, shape it the most. Is it the geography, industries, or is it just the human psychology?
Well, that's a good question. I tend to think that if a service, let's just say, established in a certain country, it's usually due to the main industries that are in the country, or it's the main problem in that country that's dealing with, and then they want to make it global. I think geography has a big impact on the success of a company in a way too, because we see a lot of startups, they could be established in Azerbaijan, it can be whatever, Ukraine, etc. They tend to want to go to North America, or in some cases, they want to go to Dubai. For example, it's becoming more and more popular in the past 2 years.
Right.
And I think social culture factors is important to know how to do business. Americans are very more business like, they're more salesy. And it's good. Average sales leads to money, right? Europe is very R&D, research and development. They're very, very passionate about the research, the development. And one thing I noticed about, which is very interesting, that I've noticed the past 2 years about the Middle East, is Saudi Arabia, Qatar, UAE. They're very interested to learn about what's going on in Europe and North America and how to learn from their mistakes. We see that the government initiatives are coming from Saudi Arabia, UAE, and Qatar to improve entrepreneurship and push AI. And I see what they're doing is very good. It's making people coming from outside of those countries to feel welcome. Like, I've been to Saudi Arabia, I've been to Qatar, I've been to UAE, and people have asked me, because I'm born in Canada, been to Bosnia, Europe, all that, and they ask me, where do you think is the best hospitality? I say the Middle East.
Mm-hmm.
I have like, it is a diamond, uncut gem, especially Saudi Arabia, I would say too. Hence what's going on with the Saudi Vision 2030.
Mm-hmm.
But nothing's for free. And I think sometimes people take that wrongfully. They think, oh, if I have a startup, if a country has a lot of capital, there's a lot of investors, so they're going to invest in me. No, you have to look at it. If you're going to get investment, it's like a loan from a bank. They need a return on their investment. But industries are very important too. To go back from what you're saying about geography, it's usually problems are going on. We saw what's going on with Ukraine and Russia.
Mm-hmm.
I remember working with an investor. I'm like, let's look into ag tech. They're like, why? Hence grain, hence fertilizers. Those are big industries in those countries that's going to get pushed. And we saw, unfortunately, with divorce, a lot of companies that deal with defense.
Daniel, you mentioned something which stopped me, and it's not only in the investment part, I think, but I would like to hear your opinion from investment point of view. So you mentioned about the kind of misconceptions that happens now, and you mentioned the Middle East, right? So as an example, and you mentioned the expectation. Now, do you think uh, is it a cultural effect that because you said people they think, yeah, there's a lot of money, it's gonna be easy, and personally I was approached by a lot of both VCs, founders, that they say, hey, it looks like, let's say, Saudi, UAE, they have a lot of money, you want to come. And my answer was like, yeah, you can come, but don't expect things to move fast. Now, is this misconception related because our region, which is where I'm living, the Middle East, I'm based in Dubai, as everyone knows. So is it because it's faster in other geographies? Or is it like the conception that we have a lot of money, that means we can spend the money very fast? What's causing, really this misconception for both founders and investors alike?
I think it's media perception. People see on the news, oh, Saudi Arabia is investing this much money in America. Oh, we see like the tourism effect, the Saudi vision, the line, the neon, etc. And one thing that I've noticed being in Dubai several times in Saudi Arabia, you have to bring something that they need. Everybody wants money. Who wouldn't? Like, everyone's asking for money.
I need money.
Everyone's asking, hey, can you buy shares from me? But what are you doing for them to be like, wow, this really sticks out. I want to work with them. And you have to respect the cultural factors. Not every, some people say, if you're from, I'll use Canada because I'm Canadian. You can't take like business done the same way in Saudi Arabia as it is in Canada. It's a different process. You have to build the trust. That's why they're very hospitable, I notice. But you have to build trust, which is, I understand in some ways too. And it's also, it's not just, hey, you could do business with someone, oh, forget about it, da da da. No, you're investing in someone. You have to know the person. You have to know how to deal with stress and stuff. And another thing I know is talking to a lot of investors, family officers, uh, placement agents, and high net worth individuals in the region of the Middle East. They say to me, if you want to get investment stuff, you have to invest in the country itself too. That's a big change I think a lot of people have noticed in the past few years. They want investments in their country. It's not just, hey,
Right.
we're going to have a fund in Dubai. Oh yeah, we're going to invest in Croatia, Bulgaria, Czech Republic. No, it doesn't work that way. And I definitely noticed it in Saudi Arabia. A lot of people have told me, yeah, we invested out, but look at all the projects we have going on in our country, from tourism, from construction, etc. We want to see people invest in our country too.
Right. And just to add to what you mentioned, Daniel, the priority, and because we know that the big money is with the sovereign funds, right, managed by government. So the priority, and I know it from a lot of my network, of course, the money to stay in, but also like to create jobs for the population living here, so the locals, and create more jobs into the economy. So this is what's the number one priority always is, and it's part of what I think, in my humble opinion, some people, they miss. Like, yeah, we're gonna take the money and go. So this is like number one. The second thing you mentioned about it is the culture. Some people, they see it slowness. I started to see signs that things are speeding up a little bit compared, like, let's say, to 15, 20 years ago. But still, I think, there's work to be done. Now, as someone who specialized, Daniel, in uncovering market opportunities. Um, so what do you think? And when it comes especially to emerging markets, what are like some of, I would call them, like, non-obvious indicators you always look for?
In terms of doing investment research, I usually look at, say, if it's the founder, some investors, they want to make sure that it's not a first time entrepreneur, that's a serial entrepreneur, hence can they deal with stress. They look at the team, but it's usually what's the problem, what's the solution, and is it a solution that is innovative, or is it just a copycat approach? That's important. And what's the market? Is the market growing or is it dying market? Like, let's be realistic. No one's going to invest in right now a company that's dealing with postage, because people
Hmm.
don't use the old school mail. So it'll be like it's a dying market. But they'll be like, hey, we're dealing with something that deals with AI search engines, or it could be mental health, or et cetera. It's like, okay, is it a growing market? And it's interesting. This one investor, this is back like 10 years ago, said to me, I like to invest in companies that are in a market that I know in 5 to 10 years it's still going to exist and grow. That's one thing I think is very important. And it depends on the stage. Sometimes they're like, what's your traction? If it's a company that's been there for 5 years, do you have traction? In other words, do you have revenue and stuff? So finances, team, market are important, but people like to work with people that they somewhat like. You don't have to be best friends, but if you don't like someone, you're not going to invest in them. Let's be
Right.
realistic.
Daniel, like, because you help other investors also as well, right? And so there is a mistake I've seen, and I want your humble, view on this, I would say, and your expertise at the same time. What's your take on founders, especially in the tech? Of course, talk about tech
Yep.
founders, especially in our region. I can't blame them because it's something considerably new, right? Like going out, raising money. I'm not saying like it's completely new, zero. No, of course, we had like successful fundraising grounds and everything. But I've seen founders, they mix up the things. So they target high net worth individuals, they target family offices, they target VCs, they try to target angel investors at the same time. And what they end up with is like their when they go pitch, and I've seen it myself, so their check sizes are wrong, and the measurements that, or let's say the traction and the other numbers you just mentioned, they're all put in the wrong way. So if you would, if someone comes now to you, especially from emerging market, and that could be Middle East, that could be, anything in the emerging market, what you would tell them, advise them to which kind of investors they should really target, especially in the early stages? Maybe they have some traction, maybe they have some LOIs, as they call them, letter of intents, maybe they have some pipeline. Who are the right folks to go to start raising? And is it healthy to mix and match the way they are doing it today?
No, good question. I think if you're a pre-seed, so if you're a company that doesn't have revenue, you should be focusing on investors such as incubators, sellers, because they can help you grow or with your product if it's not fully completed, and target angel investors. But you should look, if you're going to target an investor, what did they invest in already? They're not going to invest in a competitor of their portfolio. You have to understand, if they were investing in a company, very rarely they're going to invest in you if you're a competitor to a portfolio company. They already made a bet with that company. They're not going to bet on you too. And another thing is, if you're going to deal with family offices, they usually invest in the VC funds, but sometimes they're starting to invest directly. You have to look at their portfolio and the investment stages. So you have to do your research too and see, okay, are they interested in the industry that I'm in? A lot of investors make that, a lot of servers make that mistake. And when looking at investors, they shouldn't just look at money. They should look like, are they going to help me grow? Are they going to help me enter new markets? Can they mentor me? If you're just looking for money, I think that's probably later stage, not really the early stage, due to the fact you need an angel investor to help you get to the next stage. So it's probably good to go with the angel investor if you're very early. But if you're still developing your product and you're not 100%, go with the incubator and accelerator. Yeah, they might not give you the huge the check size, but they can provide you the tools that cost money to get a finished product, and then you can raise it in a few months later. So I would look at the investment stage that the investor invests in. Geography is obviously important too, because sometimes I see startups, they want to target certain geographies, and then the person's like, I'm not interested in Europe if they're a fund out of Boston.
Mm-hmm.
And they have to look at their portfolio. Have they already invested in a company that's in their industry that they consider a competitor? Why would you invest in a competitor? It doesn't make sense. Unless
Absolutely.
you're willing to. Very rarely. That's what I see, like a direct competitor. Like if someone invested in, I'm going to use, this is the 90s, but Yahoo, they're not going to invest in Google too at the same time. They'll
Of
probably
course.
first sell then. And you have to pitch it to them that they can understand it very simple. I always say, approach it like you would to a 9-year-old. Make it simple. Then if they want to know details, then you go into details. Keep it simple. It's difficult because if you're in tech, you're passionate, you're talking about, look at all this, the model I built, Make it simple. What are you building? What problem are you solving? 2 sentences, simple, then go into details. You have to grasp their attention. You don't want to lose their attention by saying, I built this model using this technology, this API, Because a lot of these people who are investors, they get pitched thousands of startups a
Right.
year. Make it simple, capture their attention, then move step by step. Don't expect it on the first call to get an investment. It takes time.
Check sizes, Daniel, like very quickly, if
Yep.
I know like there's no one size fits all. I'm aware of this, but I mean, do you think like sometimes, because I've seen this when people comes from the US or Europe and they say we're raising our, let's say, our seed round, our pre-series A, mainly I would focus on the early stages, right? Because late stages we go like big, we go like 8 figures and so on. Do you think the check sizes are also misunderstood sometimes, in a sense that what could be an angel investment of 100K to 150K normal in the US, it's not the norm, let's say, in emerging market. Same for the seed round. So a seed round of, it's very normal to have a seed round of 5, 7, 8, even $10 million in the US, but we don't see this here in our region. So what you can also advise on specifically, not the exact check size, but the ranges on a high level.
That's a great statement because I've seen it firsthand. I've seen companies that have no revenue, raise millions, have let's just say 8-digit valuation, and this is prior to the big open AI explosion,
Mhm.
just
Yeah.
because they're based in the States. And in some ways, people could say it's unfair. Well, sadly, life's unfair. We can all go into details, right? But I think you have to sometimes you can be like, hey, I'm raising this money. You have to back up what you're going to use the funds for. You can't be like, I'm raising $1 million because I needed this. Okay, what are you going to use $1 million for? Oh, I'm going to use $1 million, 500 to grow the company, and 500K for me and the team that okay, how many more people are you going to hire? Oh, you're going to give yourself a large paycheck of 250K. Like you have to understand what the investor perspective is. So when saying you have to also know Series A is a lot different in the States than it is in Europe than it is in the Middle East. My opinion is when you're investing, just be like, hey, I'm investing this much. It's an early stage investment. That's the safest. Because if you say pre-seed, they'd be like, oh, we only invest in Series A. But this investment, is this within your scope? 'Cause sometimes it can vary. Because you like it or not, you could say, I have a great manufacturing AI company out of Istanbul. I want to enter an American company. I want to get the same investment as a company based in Miami. No, it's not going to happen. Unless you have a really good traction and you're going to be a unicorn very quickly. There is that outliers because there's a lot of interesting companies that are founded outside of states that have changed the American market too. So we have to take that into perspective. But you're right. You can't think that, say, a pre-seed amount in San Francisco is, let's just say 60K, for example, and they only got 10% equity, these investors. You can't compare it to other countries. It's unrealistic. Sadly, it is what it is. Why? Because a lot of financial capital is in the States. We like it or not. VC was started in the States and et cetera. And location does matter because a lot of companies, if they want to be international, they try to enter the American
Right.
market. That's just how it is. But overall, if I was in a startup, I would be like, this is how much I need to invest. Why? Back it up. Back it up. You have to make sure, have a financial model, And I probably learned this from my real estate development days. I would always do optimistic, pessimistic, realistic.
Mm-hmm.
You can go with the optimistic because they're going to cut you down. That's just how it is. They're going to probably cut you down a bit. Oh, we'll invest this much, but we want a bit more equity. They're never going to give the equity one for one what you want. That's rare. You rarely get what you want on the first deal. There's a saying this one investor said, both sides has to be unhappy. Then you know it's a good deal.
Yeah, the term sheets needs to piss off both parties, they say sometimes. Um Daniel, like I want to shift a little bit gears, to
Yep.
your work with the investors actually. Now, every single article, book I read, like they say an investor, they regret not the wrong decision they made. They regret the great companies that they didn't invest in, right?
Yep.
Do you still see a lot of investors making this, um, old fashioned frameworks that they try to keep following to judge like if this is a good investment or not? Does really numbers here really here help? Is it gut feeling? Because I was having a conversation the other day with someone, and he's saying like especially now with the AI, like making these differentiations is very hard. And running the same framework that we used to do before, like, yeah, like let's check the team, let's check the solution, the problem, market size, all this. But sometimes, like, you don't have all the time to do this, and actually you miss. So in these days, what's working for investors? not to miss, of course, as much as they can.
I think some investors, and I've worked with a lot of them, they have like their own AI model. So they audit the data, they train like an AI model to scrape some stuff. Because the analyst associate, depending on the bandwidth of the fund, probably is going to catch each one. And not every managing partner is going to look at every single company. Because sometimes someone contacts somebody here, but they send it to their associate principal. Hey, look into this. Do you think it's noteworthy? Yes, let's go on. And you mentioned AI. A lot of investors, it's kind of the same fear of missing out, FOMO. They use that and they hear one of their partner funds. So that could be a fund that invests prior to them in the stage. So say if they're Series A, they have a C stage partner fund that invests company, then they invest after them. And then there's a post stages investors that follow on after them. They usually follow with them. But I've heard a lot of them have their AI models or it's word of mouth. And some investors, they're just do it the old fashioned way. With the AI, you hear a lot of companies like they're getting really big valuations. They don't have revenue. They don't even have a product available. It's just their team. We've seen it with some people from OpenAI and stuff, and it's a big bet. And we
Yeah,
see governments investing in these companies and sovereign wealth funds. Now, it's not saying millions, I'm saying from other countries too. And I would say this, you gotta go gut. And so usually if they're investing in companies like that, it's because the founder or management team came from a big company. It could be Google, OpenAI, Meta, et cetera. And they trust them based on their expertise and experience. Oh, they're gonna build something big. Yeah. And it's interesting. I believe Mark Zuckerberg said this from Meta. He's like, I don't know if I'll build anything as good as Facebook. That's why I'm so passionate about Facebook. I'm paraphrasing a bit. And sometimes it's a risk too, because it could be that they're going into another industry or another sector that they're not as confident in. But I think that's usually the case that a lot of investors are going with. They hear this, they look at the team, the management. Oh, it's a good idea. They have great experience. Let's go with them. But times have changed, definitely. And I think it's also teams are changing. So you're no longer seeing a Series A startup with 10 employees. Sometimes there's 3 now because they're using
yeah,
technology, and it could be good and bad, even funds. I'm in investment research industry. I've seen how my industry has changed rapidly. And we see with consulting, less and less there's need of market research. There is a need to audit the AI and do the insight to research, but that usually comes with the experience and expertise. And we see there's a big change. A lot of funds are like, yeah, we've got a partner and we have one associate. And they're not looking to really invest too much, or they do it in-house.
right.
And I think it's mostly network who they know. And I'm going to be very open. A lot of startups, they're going to have to generate the revenue quick with it, the money, or get a bank loan. And then you're going to get the attention. Because usually if you're a successful startup, you don't need to reach out to investors. They'll come to you because they want to get a big, nice ROI.
Do you think, build it and they will follow or they will come, will be more relevant?
It depends on your situation. If you can fund it yourself and you don't have a network, sometimes that's the best case and they'll hear about you. Or if you don't have the funds to do it yourself, you're going to have to reach out. It depends on your situation and it depends on your team. But if you have a success and being part of a team that's got investments, say you're part of a startup and it got investors in, and you have a good relationship with those previous investors, that's a big gateway because those investors can open doors to other investors, even if they're not interested. But like, hey, I know a fund, and that opens doors too. And that's how a lot of startups get investments too. So that's one way to look at it. And incubators, accelerators, they get so many pitches too. And at the end of the day, you have to, I think sometimes startups, they try to be perfectionists. And you have to be realistic. Hey, if you get stage 1 of your product out, stage 2 and 3, it will probably happen if you have a really good idea and you know how you want to do the stage 2 and 3 to make your final product amazing. Sometimes you have to go that way too. Because if you look at all these big companies, they all adapted or pivoted a bit. Look at Amazon, started as an online reseller of books. And now it's got AWS, you look at Meta, you look at all these companies, even like I'll take Facebook. I remember when it came out, I was in university. It was totally different. You had to have a university email that and then expand it globally. It went step by step.
Right.
And sometimes you have to go step by step, not go right away. I'm gonna reach for stars. And I will say this one thing. It was a prominent international businessman in Dubai. I had a meeting with them back in April, and they said to me, the problem is with a lot of startups, they think they can compete with the big companies, the big like Qualcomm or whatever. Usually they should look to work with them, see what they're missing and see if they can use your product and build a relationship slowly. Because a lot of investors, if you're a startup, you have to look at an exit plan. They're not going
True.
to just invest in you and be like, oh, we're going to leave our money here with Paul for the next 20 years. No, they want a return on their investment. It could be in 3 to 5 years, or they're going to look for a secondary fund. So for those who don't know, a secondary fund is a fund that buys shares from an already present investor and get out.
This is an important point. Again, I'm on the founder side, guys. Like, don't get me wrong. But one other thing I've seen, Daniel, especially related to what you just mentioned, the kind of creating this FOMO effect to investors, right? And coming and acting as, if you don't invest today, the world will end for you. And just fun factor, and it wasn't related to this episode, like I work in sales also as well, and always, and I was inspired by a post that appeared in front of me the other day on LinkedIn. It's was related to sales, is that usually like urgency kills deals in sales. And sometimes I've seen it also happening when it comes to fundraising, because the founders at some stage might look desperate a little bit, and this will break the trust. So my question to you, Daniel, on average, I know in the US things can happen faster, but in our region and maybe the broader emerging market, what's a fair time, I would say, to really build the trust, build the relationship, and close your round between first meetings until you have all the money needed, so you can say we close the round now without
60 to
putting
90
pressure.
days. 60 to 90 days if you have everything prepared and you're professional. But because if they're going to keep on asking and the fund is funded. So I've been on the startup side, I've been on the investor side, on both sides. Some VCs say they have this money. You have to double check, have they invested recently? Do they actually have the money? Because they say, oh, we're a 100 million fund. When did they raise? And take into consideration, VCs are kind of like a startup. They have to answer to limited partners. So those who invest in them. So it's a domino effect. The top would be probably the pension funds, the family offices, or the high net worth individuals. So it's kind of like a triangle in a way of the pyramid of startup investment. And I think 60 to 90 days is quite realistic if you have everything prepared. And I will say this, it's tough to be an entrepreneur and founder. I'm working on a project and I'm not looking to get funding from ESA because I know how it is. It's difficult. You have to prove yourself in a way. And I think it's easier for entrepreneurs to work with other entrepreneurs who are investors. Why? They understand the process. Being an entrepreneur and a startup is extremely stressful.
It is.
It's a volatile, it's 24/7 job. Like, I know I have kids. Like when you're with your kids, you're still thinking about work some way. If you're an entrepreneur, I did it. It's just how it is. And you can't think like a 9 to 5. You can't think of your corporate, oh, I can go home and relax. Oh, I'll deal with it on Mondays morning. No, you can't. You're dealing with it on the weekend. You're dealing with it when you're on holidays and stuff. And I think one thing that's really important when dealing with someone is kind of having empathy and understand what the other person is going through. So startups have to also understand what's in the best interest of these investors. Kind of like you remember the old show Columbo. Ask the questions to see what's going on. Ask the investor what they're interested in, what antagonizes. Do your research. And yeah, do not I know it sucks, but you have to somewhat be expect the worst. When you expect the worst and you get something good, you're jolly. You're like, oh, this is amazing. But if you have unrealistic expectations, it's tough. And sometimes you can have pessimistic expectations and it doesn't go that way. It becomes worse. That's just how it is. There is no perfect days being an entrepreneur. That does not exist. If you're going to take risks, you got to deal with stress. And you have to be able to be calm and accept criticism when dealing with investors. Do not think you're the biggest thing. Be calm, be respectful, and be confident. And be prepared for the worst questions. Be prepared for them to insult. Be prepared for them to be like, oh, what's this? What's this? And pause. Think about when you're going to answer if it's something that cuts you off guard. Because they're going to ask you those, as they say in baseball, those hardball questions. That's just how it
Right.
is.
When you say getting prepared, Daniel, just if you allow me, like to
Yeah.
open it a little bit. So we talk about data rooms. So you need like to have your data room cleaned up. So you have your paperwork. You have, if you have some transactions that should reflect your financials, your legal. Of course, your pitch deck. Of course, like must have first thing first. Um, so when you reach out to investors, like you don't just actually, if you're not ready, probably they, correct me if I'm wrong, Daniel, if they feel like you're not ready and you're kind of like, yeah, let me work on it, let me prepare that. So probably not all VCs are like tolerant in this and having time. So they need you to be prepared, come to them prepared. I think one of the things that I noticed personally, Daniel, that this part is still work in progress, at least for us here in the emerging market. I mean, uh, for founders, because they think, hey, I'm raising safe note, like let's say $5 million. I'm sorry, like $500,000, 5 million cap, 20% discount. So they just copy paste the terms and they flash out the emails to all the investors that they found in a database or something, and then if someone reply them, they will start asking, okay, do you have a data room? Do you have this? Do you have that? And I've seen it, like nothing over there. How much, education still we need to do? And I know like some founders, they get sensible of this, and I understand them. There were some, unfortunately, especially here, I heard a lot about things in Dubai where people like they said, yeah, we're gonna help you in this, we're gonna like do this, we're gonna do that, and then they took money and they disappeared. I get you guys, but still, that doesn't mean that there is like real experts that they need to guide you. What I want to ask you, Daniel, like if founders like are a little bit more technical, they are like developing the product, they don't have this experience, who sh- how they can learn it, or they should bring someone with them to help them on the fundraising journey.
I would say this. You don't have to, if you don't want to bring someone in the fundraising journey, that's up to them. I always say everyone has a right to choose what they want. They should think like this: make the data room as simple as possible. That I say that anyone who doesn't even understand the company can go through it. They don't need you to explain it. And I think for tech people, they understand it, hence they deal with coding. So they have to break it down, uh, lines and stuff for coding. So I would say this: break it down into a few folders. If you want a data room, you could put on Google Drive, whatever, for the time's sake. And then if someone's interested, I would put organization. So that's in corporation documents. Then I would do finances, your statements, and your financial models. Third would be the operations, how the company's operating, any contracts, and et cetera. Fourth would be the product and R&D. Fifth could be sales, and then you got marketing, et cetera, depending on the company. And make it, organize it, and update it routinely. So when someone asks, like, oh yeah, here's a data room. When you do that like that, you're like, wow, this person's, I know, I've seen it on investor side. They're like, wow, this is good. And those companies I've seen, just basic organization and communication are usually the ones that succeed. And I've seen company that did it. They had, I think, I'm not mistaken, they were 600K annual revenue, and they got bought for like 10 digits.
Hmm.
And they were so organized, they were so easy to work with. And if you're easy to work with, investors will like to work with you more. So be prepared before you pitch. Prepare this. Oh, you need this. And if they ask for a deck, have a deck. It could be a small one, it could be a big one, and have like a quick 2-page or a 1-pager. Because if they're dealing with something, they're not going to go through your whole 26-page deck. They're going to want, okay, pitch to me in like a bit. So they have to have make it simple. That's what I say. Make it simple so you make it easy for them to understand what you're doing and that it's easy to communicate with you.
Right. Um, One other thing I want to ask you, Daniel, about is also related to the investors themselves. So, what we tell founders to go and search for smart money, right? Um, of course, in an ultimate scenario, they should go search about this investor and try to see maybe first, if they are a VC, their portfolio companies, like who are the partners there, like their history and so on. But what other things, would make this investment smart money for the founders?
If they can see if the investor has a big network, if they can see they can open markets for them, like say if you're based in Madrid, Spain, and you want to enter American market and you're talking to an investor and you have an investor from Europe and an investor from the States. And the one in the States can connect you with companies in St. Louis, Kansas City, and et cetera. You're probably going to go with the American one if you want to enter the American market, right?
Hmm.
So look at their location, doesn't matter. Just look for a startup. We're talking about startup location. It matters also for investment. And do they have a presence in that market? Because it could be based in Dubai, but they have a big network in the States. So that matters too. So I would say their network and expertise. What's their background? Are they just, I don't want to sound rude, but someone who just inherited their money from family? Or did they have an exit in the company and they're investing the money that they exited to other companies to build their portfolio of wealth? So I think experience, expertise, network, and sometimes it does matter. Do you think this investor has their best interest for you, or are they going to be a vulture? And this goes back to knowing the legal language. Are they going to be a preferred share investor, kick you out in a year and put someone else in there because they like your idea? And startups have to look into that stuff too. They have to know the venture capital terms of negotiating. That's important too.
It's very important, and I think very few do that, unfortunately. So, and we are coming to close, Daniel. Like final words you might want to share, with the audience today, and where people can, know more about you and get in touch.
Uh, I would say this: the world's changing, like you mentioned, about investment, and I think location with time is not going to be as important as with the enhancement of technology because you can work from Bali and run a company. You can work in Dubai in the beautiful beaches in Dubai and run a company that's based in the States in Delaware. So I would say when investing, if you're an investor, invest in the team and stuff. Don't focus too much on the location. If you're a startup, think of the worst case scenario and think about what the investor needs and wants. And patience, as I say, is a virtue. So try to be patient when it comes to growth and success. But those who are interested can reach out to me on LinkedIn at Daniel Nikic. It's a pretty unique name. So there's not many of us. And they can check me on my website at www.danielnikic.com.
No problem at all, Daniel. Don't worry about how to find you. I'm gonna put the links in the show notes so the guys they don't have to go and search it up. I really enjoyed the discussion, Daniel, and I think this worth to have a part two, just about the VCLP also as well, because that we didn't touch much about it because I wanted today to focus more on the founders part and the global investment things and what's happening around us. But just as like underlining what you mentioned, it's important for founders. So location, as you mentioned, if like any takeaway I would take today from you, Daniel, is like the location as you mentioned. The second thing is don't rush things. Don't try to over smart or I don't know what's the right word here, like to rush things in a nutshell, and understand also like investors themselves, they have their own um, processes also as well, and especially for VCs. So these guys, as Daniel mentioned, so they report to LPs, and maybe they did first close, maybe still the whole fund is not there with them, maybe the money is not in their account there. And don't get them wrong, because sometimes they have to source deals so they can show their LPs. So you need to be smart enough, as Daniel mentioned, and go do your homework. And again, Daniel, thank you very much for all the information you provide us today. I really appreciate that. They will find the links in the show notes, as I said. And this is how I end my episode. This is for my audience. If you just discovered this podcast by luck, thank you for passing by. I hope you enjoyed it. As you are seeing, we're trying to mix the topics from every aspect related to entrepreneurs, and of course to investments and operators also as well. And if you are one of the people who keep coming again and again, thank you very much for the support. Thank you for all the, you know, great work you have done for me this year, 2025, like putting the podcast in the top 200 Apple Podcast charts in multiple countries. We keep changing countries every week, but there's no one week without being in one of these top 200 charts. So thank you very much for the support. And as I say always, stay tuned for a new episode very soon. Thank you. Bye bye.
Hit that subscribe button, share the show with your tech-savvy friends and fellow entrepreneurs, and leave us a review on your favorite podcast app. Your support means the world to us.